Before we go deeper on some of the economic data, it's important to understand how the investment cycles or investment profiles are changing. And Asia Pacific is obviously a broad region, but the global semiconductor industry has obviously brought car manufacturing to its knees. We've seen the impacts that technology shortfalls, semiconductor shortfalls can really create. So that's why when we look at what is that driver? Like where do we go from here? Where's the investment? And the global market share is obviously, when you look at Korea is 19%, Japan's 10%, Taiwan 6%, China 5%. So you can see just where we are right now, but where are we going to be? And how is that investment really looking? So based on 2030, just based on the forecast, this is done by Deloitte. I've shown something similar. Korea is looking to essentially stay flat based on their investment cycle, but some of their companies are investing in the U.S. So the companies themselves won't have it local, but they'll have it abroad. Same with Taiwan. But China is the one that is looking to go from 5% to 15%, and they are the biggest drivers of investment. When you look at who is investing dollars in new manufacturing, as we've said before, China is the biggest buyer of semiconductor equipment. They want to become the biggest provider and supplier, and they are the biggest consumer of semiconductors right now. They want to help diversify themselves further, especially after what happened with Huawei, what's happened with some of these additional sanctions and underlying pressure points. So then the government investment in the semiconductor industry in Asia. This gives you an idea of how they're doing it. So China was at negligible in 2018, 31.1 billion in 2019, and 35.2 billion in 2020. And I'll give you a guess, they're up again in 2021. So even though they're doing everything they can to bring down some of the liquidity, the leverage side, you're seeing some of that adjustment in general, and they're trying to invest in this industry. And the proportion of semiconductors in GDP, when you look at what is the driving force of GDP in the region, for South Korea it's 7%, Taiwan it's 6%. China wants to make this a bigger driver to their GDP going forward. They need to diversify. They need to get away from manufacturing and that export side because it's accounting for less and less, and the consumer is still struggling. So going the tech route has been their focal point and remains based on how they're trying to capture this market and become a bigger player and a bigger driver throughout. But in the meantime, let's look at what's happened within the Chinese economy. So when we look at China non-manufacturing PMI came in at 52.4%, which is really what we have been talking about on the services side, where you're going to get a little bit of a pop. Again, it's going to come down. You're going to see some of this normalization. But manufacturing was where we said it's going to be below 50. And here we are coming in at 49.2, bringing the total composite to 50.8. So negligible growth. And that's what we've continued to see is this negligible growth side. So now the CACs in China manufacturing came in at 50.6, slightly better than the official numbers. And then the composite came in at 51.5 because services for the CACs came in at 53.8. So when you look at some of the shifts in general, that's where it depends on who you're asking, what level you're asking at, and what those expectations are. So like when we look at the official data, non-manufacturing PMI was expected at 53, came in at 52.4. Manufacturing PMI was expected at 49.7, came in at 49.2. So that's where, again, you're seeing these pressure points that are really starting to drum up. And we'll talk about more of them in a minute, some of them coming from China Beige Book, who has some excellent data. So then when we look at China's PPI and industrial output, so PPI is continuing to go up. We've continued to see it drive higher as we know where it is based on those dotted lines, but they're starting to raise prices now. Two massive conglomerates have increased their prices anywhere between 4% and 12%. So now they've come to the point where there's nothing else they can do but to pass this on to the consumer, which is why the consumption is going to get even worse than it already is. And that's where we see that energy-intensive industries are coming down. Why? Because energy is expensive. Other industries are starting to flatline, but you're seeing the PPI pressure, you're seeing the consumption pressure, and now you're starting to see that roll out across the whole industry. And the China general manufacturing coming in at that. So China October non-manufacturing PMI, the manufacturing PMI, as we've been talking about, this is where we see these pressure points, is on the manufacturing side. New orders are down. Imports are down. These are the pressure points that are going to show where there's going to be more problems, more export issues. And if you can't export your prices, you're going to have to pass that through. And we're starting to see that as the pressure mounts for the local consumer. And that's also creating more high yield bond credit angst. And you're starting to see that show up in fixed income, where people are showing some of their fears, and they're showing it through fixed income. And typically credit leads the charge. And I think this is not being holistically ignored, but broadly ignored, especially in the region, for what this could mean for, again, defaults, additional stress within the system, and how are they going to backstop it? Because we know that assets are light. We know that there's a lot of collateral that has been collateralized multiple times, increasing some of the pressure points as how do I get my money back? And the contribution to Chinese export growth by region. So where is it going? And when you look at Asia, it's been going into Asia, it's going into Europe, and obviously North America. But the growth, where's the growth going? And this is why, as we said last week, it's so important with the deals that they're trying to make with the ASEAN, because they see the opportunity to help mitigate their loss of North American exports, and they want to grow within the local region. It makes sense because they easier to ship, shorter distances, and you don't have to worry as much on a political side, especially as the rhetoric continues to get worse. There was a lot of talk today about what's happening with their nuclear arsenal. It's bigger than expected. It's accelerating past the pace that we were assuming. So there's a lot of fear now in terms of, well, what is this going to look like? Like, where are we shaking out in terms of the relationships between the two? But while all of this is happening, Fitch is continuing to downgrade, as we said they should back in February of this year, was just how bad the situation was on the credit side, with downgrades only accelerating and more to come, with additional entities unable to pay their bonds and loans. And that's what we have more coming. There could be a triple default on Evergrande with some of the new the new grace periods coming up, and there's other areas that we've seen additional pain. And the reason why, let's look at 2/3 of the top 30 Chinese developers crossed at least one red line. Because remember, there were 3 red lines that were laid out by President Xi. 70% ceiling on liabilities to assets, 100% cap on net debt to equity, cash to short-term borrowing rates. When we look at those red lines, Evergrande is tripped over pretty much all of them. Then when you look at Country Garden, where in one of these, when you look at where these things sit and the number of lines violated, you can see just the amount is increasing in general, creating more and more stress as they're trying to address it, as they're trying to kind of corner this and isolate it from expanding into other regions. But yet, China's property sector is in a tailspin with high-profile companies on the verge of defaulting on their bonds. Now, this is looking at the China Real Estate High Yield Index Total Return Fund index, because obviously it's getting worse and worse. There's more and more risk, credit risk, that's being baked in, and it also makes it very difficult to roll your debt, to issue new debt, and a lot of these individuals don't have that ability to do so anyway. So while all of this is happening, you're getting the hoarding side. So there was a backdrop of the importance of hoarding. So coming from Trivium, it wouldn't hurt to stock up on a reasonable amount of daily necessities this winter. That was the message from the Minister of Commerce, buried in a much longer routine notice issued late Monday about how it is managing weather-related vegetable price spikes. Now, by Tuesday morning, That call, the call to stock up had gone viral. Many read it as a sign of impending crisis. Lines formed outside supermarkets around the country. Skittish investors bailed out of most stocks, which ended lower across the board on Tuesday. Within hours, efforts were underway to reassure the jittery public. Then this is looking at newspapers. Party newspaper Economic Daily told readers the close attention to netizens is understandable, but it's completely unnecessary. The suggestion of stock up is related to epidemic control measures because they have a big is relative, obviously, a big outbreak in terms of COVID. The head of MOFCOM's Markets and Consumption Department was also deployed for a series of interviews with state media to repeat that the supply of daily necessities is sufficient and fully guaranteed. MOFCOM was just doing its job. They send out notices like this one pretty regularly. There's not a shortage of food or toilet paper on the horizon, but the overreaction demonstrates a serious shortage of consumer confidence, which we continue to see crop up through our channel checks and what we continue to see in the system. Some believe that it meant that there was going to be an invasion of Taiwan. There was going to be an additional issues and sanctions. We hope the combination of fear-mongering and war-mongering will finally get Beijing to tell overly excited online nationalists to delete their accounts or at least touch some grass. So essentially trying to come back down to reality. So when we look at how all of this is happening, well, Yango Group bond prices, pennies on the dollar. Bloomberg China US dollar high yield index price, coming down to 75 cents on the dollar. All of this is happening. You have fear with the consumer. You have an issue with additional shortfalls, people defaulting, people entering into grace periods. But all of this is happening with essentially what I keep talking about and the pressure that continues to mount. China manufacturing PMI supplier delivery times, longer delivery times. Input prices near a record. So they're above the 2021 highs. So how are you going to pass on that input price, which is why more inflation is expected, increasing the jittery nature of the Chinese people? Which is where, when you look at the factory rebound globally, good news for supply chains. Global factory activity is reviving in October. Of the countries reporting thus far, we count that 96% are in expansionary territory, the best since 2017. Emerging market Asia in particular has shown notable improvement despite sluggish growth in China. So here's where we're seeing this backdrop. And this is, I think, a good example where we're not calling for a recession. That's not what this conversation is. It's just China is mattering less and less. And it's because people and companies are going out of their way to diversify. They're going out of their way to shift and move their supply chains to address these specific issues. So you're seeing Vietnam, you're seeing emerging markets, especially in Central Asia, Southeast Asia, that are seeing a lot of this growth because this is the driving point. We keep seeing this move through, and it's a net positive as the supply chain continues to move. But when you look at when we now look at this on USD credit versus China high yield credit, you get an idea of just how bad this is and where it was back in the early 2010s, and how it's now replicated to what 2011 was. That was Fukushima. That was the European debt crisis. So now that we look at that, let's go a bit deeper into some of the Chinese the Beige book data. So China has called on families and local governments to stock up on daily necessities as the country enforces stringent restrictions intended to curb number of COVID outbreaks. And again, that's where they've continued to drive that. But let's look at manufacturing. Growth factory activity decelerated in October. Manufacturing revenues and profits each slowed sharply. So when you look at 2021 Q4 versus Q3, it got worse. So where is Caxton coming from? Like what are we looking at right now? Because these numbers based on Q3 and Q4 are in much deeper contraction versus talked about. Predictably, production growth fell, with 19% of manufacturers reporting greater than 10% cuts to output for reasons of both the holiday and power outages. This should be temporary. So the hope is that September was weak, October was weak, but you're going to get a step up in November, but the question is, where are input prices? Input prices surged. Where are new export orders? They're down. Where's consumer confidence? Low. COVID cases are rising again. Again, energy costs are going up. So how much of this is going to come back is, I think, a much bigger question. So services also lost steam as both revenue and profit indexes fell by double digits. The severity of new COVID outbreaks may be the real tell of service performance in Q4 as effects from the mid-autumn festival fade. So here again, big walkbacks across the board as you have additional pressure. And depending on COVID, so when we look at COVID outbreaks, the rural outbreak had a much less impact on services than the urban one. And now this one is hitting both sides. So this is based on how quickly they can get in front of it is going to dictate how quickly some of the services can return. I am not very hopeful for what what November is going to look like at this point in time. And then the power crisis, again, coming back to what should be short-term, manufacturers felt the power crunch pain. Nearly 2/5 of factories experienced cuts in their power supply in October, with 10% losing electricity for 3 or more days per week. So that will abate. This will normalize, and that will bring some of that back. But who are you selling it to? With what inputs? With what supply chain? So some of it will just become a bit more stable, but it doesn't mean you're going to have a place to push it into. And coming full circle to that non-manufacturing and the manufacturing side. So when we look at PMI manufacturing across the region, so we had Korea slow down a bit, which we talked about was going to happen based on some of their exports, but still expansionary. 52.4 last month, 50.2 this month. Taiwan stable. Vietnam, huge jump, 40.2 to 52.1. That was, we think it kind of cools off at 53, 54. That's going to be strong. Malaysia, 48.1 to 52.2. Indonesia, 52.2 to 57.2. The ASEAN nations are going to continue to be strong. We've said it from the beginning. We're continuing to say it. ASEAN nations, especially Vietnam, is a great place to invest right now, is going to continue to get those investment dollars as people look to move away from China, as we've been talking about and we just showed just now. While Thailand has kind of flatlined, Japan continues to be around this 53. So there's still some of this excitement, but India is another big one that saw a big increase. So India increased from 53.7 to 55.9. 8 infrastructure industries dropped in September, but there was a big bounce following that September slowdown as India continues to see a bit more of a resurgence. And the benefit is tax revenues outpaced expectations, which allowed them to now cut gasoline and diesel taxes, 10 rupees for diesel, 5 rupees for gasoline, helping to ease some of that inflation while they're continuing to experience input price increases, vegetable oil increases, and food in general. So inflation is still going to trend up, but this will help mitigate some of the full bite. And then when we look at South Korea core CPI, shifting expectations were for 2.5%, actually came in at 2.8 and trending up. So far, estimates are that it's going to be over 3%, which is why the central bank is likely to raise rates once again from 7. So they'll raise it 25 basis points. So it'll go from 75 basis points to 1%. And then the Japanese industrial output and inventory. Industrial production dipped a bit, but inventory remains fairly stable. This is where, again, we don't expect growth to really continue. Like, they're not going to go from a PMI of 53 to 57, but there's enough to keep them at that 53 rate, and then you'll see some of that normalization in the ASEAN countries, providing some of that backdrop as countries look to diversify again away from China. So I know we went through a lot. If you have any questions, you'll know where to find us on Twitter or obviously in the comment section. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.